Hello and welcome to another edition of Nucleus Investment Insights. Obviously a big day, the start titled What Now? So what's the fallout of the US election? And so I thought we would grab Dave as well. Welcome aboard, Dave. Good to see you.
Yes, great to be here. And
yep.
Yes, interesting times, as the Chinese would say.
That's right. And probably more interesting for China than most.
That's right. Exactly.
So what now? I just want to highlight, everything here today is there's nothing in here is personal advice. It's all general in nature. If you do have any questions, drop them into the chat box. Click like and subscribe if you like what you're hearing, and certainly drop in any questions you've got about where things are going. And so basically what we wanted to run through today was what's the agenda for Trump, impacts on various asset markets, different countries, in particular China, Europe, emerging markets, Australia, and then what should you be doing with your portfolios beyond that. So I might start, Dave, with you, the agenda for Trump.
Okay. Sorry, I need to flip to page 2. So it's pretty easy to summarize: tax cuts and tariffs, at least in terms of the kind of macroeconomic implications of Trump 2.0. And I guess you can see why that would appeal to the American people. And protecting industries and giving them tax cuts is not an unattractive prospect. And so, perhaps we can forgive them for electing Trump 2.0. Seal the border, obviously. So by that I mean address illegal immigration. Now, I don't know how that's going to be done. It remains to be seen how ruthless it is and whether they will round up and export people, which would be a very bad optic, but who knows? Trump tends to deliver on his platform, at least the major commitments in his platform. But in terms of, labour market implications of that, Trump is also committed to expanding legal immigration, which is really interesting because we watched, maybe 3 months ago, an interview with him with a bunch of boffins, from the various think tanks, and it looked like he kind of came up with that on the spot, and it became national policy. So nonetheless, it is now policy. So that has an important implication for Australia. If they really do liberalise inflows of people, it will doubtless be focused considerably on education, which is likely to suck away a lot of Australia's market share in international education, which quite frankly would probably be a benefit to Australia.
Okay, so I think there's a lot to unpack here, but I think there's probably, can I just take one step back? So that there's sort of, as with every politician, there's core promises and there's non-core promises, and there's the sort of day-to-day reaction to things that are going on. But I guess what we're saying here is that, look, the immigration one is their big one to do. That's the
Well, I think you can say that the 4 big ones are tariffs, tax cuts, border, i.e. immigration, and end wars.
Yeah, I would add a 5th to that, which is the decreased regulation where possible.
Yeah. Okay. Sure. Yeah.
So and some of this is I think there's certainly an optic. I think particularly if you sort of tend towards the left or you're not from the US is to sort of go, well, if you're cutting deregulation, that must be terrible. Oh, sorry. So if you're deregulating and cutting regulations, that must be terrible. But there will be some benefits in there as well in terms of different sectors can swing from over-regulation to under-regulation, and it's always about coming up with that sort of happy medium. And there's some reasonable arguments that there are particular sectors where you've ended up with so many boxes to check that nobody actually even bothers to look what it is. I like to use the example that we suffer from this in the ASIC regulations in Australia, in that when there's 20 big things you need to check off on every quarter to make sure you're compliant and all that type of stuff like that. It's easy to get those 20 and have a think about them. When it turns into 120, all of a sudden it turns into a box ticking exercise, and people don't think as deeply. And so there is some benefits, I think, in terms of those that deregulation. There's dangers as well, but
So energy is another one. I don't think this is all that different. I mean, drill baby drill is more a slogan than a reality. We're drilling under Biden, and will continue to do so. A more material outcome might actually be the return of Russian oil and other commodities if peace breaks out in Ukraine. Anyway, that all remains to be seen. It's not really part of Trump's agenda specifically, but he's fortunate enough to be winning an election where AI and weight loss booms are ramping up. And so that's a nice tailwind. And then we get to, the really troubling features of the Trump administration. And that is, of course, this is their second round in power. And, they've no doubt learnt the lessons of the first round vis-a-vis the deep state and checks and balances within the system. It looks like they'll probably have all three House, Senate, and White House, so there'll be very little check and balance. And the next logical step for the Republicans, and they've been pretty open about it, is that they will stack the deep state with their cronies, even further eroding any kind of limit on executive power.
Yeah.
And this is where we come to, Trump's more despotic tendencies. And I have no doubt whatsoever that he's going to have a crack at a third term at some point.
Can I just jump in on the stacking part? So the part, I guess, I'm watching, because there's lots of different issues with this. There are still some adult voices in the room in some of the people, and probably Lighthizer is one of the was a trade sort of czar in the last round, and he's still quite heavily involved. So there's a couple of sort of more senior sort of people who wouldn't be objected to, I guess, from both sides in terms of those types of funds. There is a slight check in terms of who he's going to put in insofar as mental blank on the Republican senator who the leader of recent Republican senator leader who's resigned and is finishing in 2 years is sorry, Dave, can you give me what's his name? used to run the House for ages. McConnell. Yeah.
Oh yeah.
So he's retiring, and there is a little bit of a section of people that might mean that the real crazies have a bit of problems getting through the Senate in terms of
yes.
He's not. So there's potentially a few there that might hold out, and the Senate has tended to be a little bit more independent of Trump, and especially given McConnell's retiring, and there might be a few others he's got sort of in that same vein.
Look, I'm really only making 2 points here. One, this is the second time round, so they'll have a better plan. And
yes.
Two, Trump is a narcissist, a toxic narcissist, and these people only function by getting more. Now, he's already president, so more means emperor.
Yeah. No, I'm not against you on that, but I do think there's a.
I don't know if he'll succeed, but I think he's going to try.
Yeah, that's right. I do think you're right there, but also I think there are some elements in terms of some of the constraints they were trying to put on Biden in terms of what he could do in terms of executive power might actually come back through the courts the other way around. And I think there are some elements, particularly there's some recent legislation that's passed that actually means that a lot could be stymied.
The institutions held up in the first round, and maybe they do it in the second.
They're going to be under a lot more pressure. But I guess what my
let's hope so.
Yeah, and I think I guess what I'm trying to say is I think there's some of I think what we need to do is just be careful about ones where something like tariffs, where we're like, yes, that can be put on pretty easily, and that'll get up and running, and that doesn't need to pass legislation. There might be other ones where I think, as you said, Trump will push the line about whether he's going to push through some things because it's in the grey area about whether it needs legislation or not. And I think those ones might end up being caught up in courts and everything like that. That you will need to get that legislation through. And the other thing is, I think Trump has been avoiding. I think there's been sort of he's been speaking it as like he doesn't want to jinx it in terms of setting up who the people are going to be that'll be part of this administration, and the interim ones have been sort of refusing to sign various things that would allow them access to a lot of government information in the interim. So we'll see what happens in that. But one of the problems we saw last time around was it actually took them a long time to get going, and potentially that might actually be the same again this time, just in terms of how.
Well, I assume they'll be quicker, but maybe wrong. They're not overly bright. So we thought we'd cover asset markets before we go to individual countries, just because the asset markets are going to really impact countries. So I mean, one of the primary implications of the Trump agenda with tariffs and tax cuts, so cutting off cheap foreign goods, looking to create a domestic investment boom to replace them, and then juicing demand through tax cuts, very inflationary stuff. And so, the American dollar to the moon. We've already seen quite a lot of bond carnage, and there may or may not be more to come, but I certainly think that the Fed's easing cycle will be curtailed on the Trump agenda. We'll probably get another 2 cuts before the end of the year, but then I'd say all bets are off as the new administration comes in, maybe one in 25.
And sorry, it's worth just mentioning on that US dollar to the moon, is that Trump did have this sort of policy of a weaker US dollar in order to improve exports and things like that. But I guess what we're saying is that seems unlikely. It seems that given the pressures.
Oh, look, he's flipped on that anyway. He's moved to strong dollar rhetoric now. He's given up on fighting it. So,
right. Okay, sorry, I'd missed that one.
That's fine. He's happy with the strong dollar now. Stocks to the moon. We think on tax cuts and juice domestic demand in the short term. As you're going to see multiple pressures here, where you have both demand juiced at the same time interest rates have already risen and may rise a little further, and so things like U.S. housing will slow, but tax cuts are pretty good for domestic demand. They're likely to be significant and material for corporations, great for the stock market. The previous Trump tax cuts were all going to roll off, but they'll be sustained and there'll be added, new ones added. So he's talking about cutting corporate taxes from 21 to 15%. If he has both houses, that's a cakewalk. And then there'll be individual tax cuts. There are lots of kind of sectional commitments to tax cuts as well for individuals. So, lots of fiscal, which will slow the Fed.
And to put in just context where we are in terms of markets. So markets are sort of trading on 20 or just under 22 times earnings. But if you get almost 10% increase in profits just through the tax cuts alone, then that brings you back to above average, but not wildly above average.
And strong fiscal boosts nominal growth, and that's great for profits. So even if it boosts inflation a bit, profits are likely to be, pretty decent. And worrying about sort of margins coming down because wages go up, I think, the sort of bait and switch between sealing the border and opening legal immigration more or less takes care of that. So, and at the same time, US wage growth at 4% with core inflation running at, 2.5%, I think, at the moment. I mean, that's fantastic for living standards. Like, there's nothing wrong with that. And if Trump can keep, real wages rising at 1 to 2% per annum, then that's fantastic for consumption. Then I think, there's a kind of game of two halves here with this, because I would imagine he'll come in pretty strongly with tariffs initially, and he'd want to come in pretty hard with the tax cuts at the same time. Otherwise, he risks, basically a growth gap in his first year or two. So I expect they would come in simultaneously. And, so the Fed, sort of pauses while the inflationary impacts of the tariffs come through in 2025. But then, the tariffs really do land on growth by 2026, if not earlier. And so the Fed resumes cutting. And then, of course, stocks to the moon again.
Yeah. Let's just go quickly to a sales message before we jump into how this is going to affect specific regions.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so on to the regions, and in particular, the biggest one, China.
Yeah, so, I mean, the reason we started with those asset markets is I wanted to sort of suggest that the basic macro framework for the next couple of years is a US inflationary boom and a global deflationary bust. That's, in effect, what Trump is setting up. And China will be leading the second part of that, which is the, global deflationary bust. So, 60 to 100% tariffs on China will hurt. And, probably 2%-ish GDP hurt as volumes crash. And I don't expect it to go into tit for tat tariffs. It doesn't want to create a kind of global tariff war. That's extremely bad for it. I would expect it to be more kind of tactical. So, I would think that it will devalue the yuan pretty significantly and do what it did last time, which is, target specific American trade to China, which it's about 150 billion US, and about a third of it is agriculture, and they're the ones that put Trump into power. So they're the ones in the garden. This is so often the case with Trump and his support base. They tend to be the ones that wear the fallout of his policy when they're kind of voting for values rather than self-interest, which is pretty typical of a populist.
A noble sacrifice. David.
A noble sacrifice, yeah. So they're so keen, to kind of crush the urban elites and their woke values that they're happy to put in policies that actually end up hurting themselves. So I think China would target things like soybeans and corn, although a lot of those have fallen away, but they're still significant.
I mean, depending on how much,
and they're going to hurt the Trump base, right? That's what you said about doing.
And depending upon how strong the US dollar is, anyway, that's probably the biggest factor in any of this. If the US dollar goes up by 10%, then all of a sudden I think
it probably will. I mean, in part because China will devalue, or at least allow. I mean, it's a 2% blow for Chinese GDP. It's very deflationary for China. So the PBOC is forced to cut more quickly, and it's just au naturel that the currency would fall at the same time. But they just won't fight it. I mean, they usually fight it, but they probably won't. They'll be busy crafting the right bribe for Trump, whatever that happens to be this time around, occupying his hotels, or who knows.
More money for Jared to manage.
Who the hell knows?
Yeah. So I mean, but I guess it's interesting. This is the part which is one of the big unknowns, isn't it? Is whether the Supreme Court sort of passed some measures which basically seems to suggest, as long as it's vaguely related to his job, Trump can accept bribes. Seem to be what they basically said was. And so the question really comes down to saying, if he's going to pick, most populists need an enemy, need the evil, and so partly that's the left-wing liberals, and partly that's been China. And so the question is it enough? Can China craft a bribe that's enough that he decides, look, you know what, maybe China doesn't need to be the enemy anymore, and sort of wounds this, or is it the fact that he can say, well, he can take a little bit from China to sort of smooth the edges, but he wants to keep them. He needs an enemy somewhere. He needs an external enemy, and so that's China's a pretty.
I mean, who knows? I don't know.
Yeah, but it's one to watch anyway. So
it is. Yes. Watch. And so in the short term, we've got this NPC meeting right now. The Communist Party is meeting, and obviously timed for the American election, for their final kind of announcement of the current stimulus round, and it will clearly be beefed up because Trump has won. Look, I've seen most people sort of suggest by about 20%. But, in terms of growth, this stimulus is very weak anyway. It's much more about de-risking and inflating asset prices than it is about boosting growth. Out of a potential $10 trillion stimulus, maybe $1 trillion would boost growth. So that's just a watching brief to see what Beijing does. They'll need more growth stimulus of some sort, which I don't expect to be very effective. And I don't think, I think China's structural problems are irresolvable. And so, this is a blow that they just do not need, and it will double their problems. So, yes, certainly more fiscal, certainly a weaker yuan, certainly faster rate cuts, which is what they really need, because they've still got a very high real interest rate, which is incentivizing everybody to deleverage. So it will help in that sense, but I don't see, the one thing that China needs to do, everyone knows, is decentralize the economy, make it, structurally reform to boost consumption. But, the Communist Party is just not down with that. Like, it means selling off the assets that they own, the state-owned enterprises, and and they don't want to do that. Like, that's both the source of their wealth, and they don't want to give that sort of power to the people. So they're between a rock and a hard place. I don't think they can go consumption because of their political system. And so what I fear in this term of Trump is China's stimulus fails repeatedly. And in the end, they turn to kind of Marshall stimulus, which is invading Taiwan, which Trump has basically said he'd hand them Taiwan, more or less. He's certainly not keen on foreign wars. That said, the Pacific has been much more valued by Trump's advisors, and so I wouldn't expect him to just sort of sell out the Pacific, but it's quite easy to see Trump doing a deal with Beijing over Taiwan at some point. And rather than create consumers, China may create soldiers.
The other thing to note is that, while we spoke about inflation in the US coming from a mixture of all the extra fiscal spending, we've got this inflation versus deflation battle, haven't we? Where we're saying, effectively what we're saying is, given the tariffs, what we're going to see in China is they're going to need to be devaluing their currency, which is going to export deflation. They're going to have all this extra capacity because they've got these massive tariffs in the US. And so they're going to try and dump that on as many other markets as they can, including Australia. Yep. And so you're looking at sort of a goods deflation ex to US, where it's got that one-off tariff sort of kick up. So yep. Goods deflation sort of fighting against services inflation.
Yeah.
And that's sort of that's going to be the main battle.
Absolutely. And you can expect China's dumping to become a major issue. It's already a big issue, but a major issue over the next 4 years, because all of those goods going to the US are going to go somewhere else.
Yeah. And the question for country,
which is a good jumping off point for Europe.
Well, actually, before we get to Europe, I guess we're moving on to Australia as well, aren't we, in terms of this? But in terms of China, this is the interesting part is, isn't it? It is moving into Europe as well, but it's the idea that, so the US is putting on these tariffs. China's now going to start trying to send its stuff everywhere else. Is whether Europe decides to put tariffs on as well, which is maybe a solid maybe. The question is, what does Australia do? Does Australia decide to just say, well, we'll just take the cheap goods, or do they decide to, or we'll just decide to further decimate our manufacturing sector?
Increase immigration.
Yeah, that's right.
Well,
but yes,
the answer to everything. So Europe's in real trouble. It's already got very weak growth, and is already locked in almost a existential struggle with Chinese EVs, which are annihilating the car sector upon which European and particularly German mercantilism has been hung for the last 30, 40 years. There's the spectre of competitive devaluation here between China, Europe, actually Japan, EMs as well. Once you remove US demand from the global economy, to the extent that the tariffs do that, then everybody's left scrambling for market share. And, it's very deflationary because there are too many goods, and so everybody's cutting rates and everybody's trying to devalue their currency. So deeper rate cuts in Europe, deeper tension with China for sure. Fragmentation of Europe becomes a big issue. You've already got China trying to peel away states within the EU. You've got other populist states within the EU that are sympathetic with Russia, and now you have the return of Trump. And he's going to pull more support from NATO, forced settlement in Ukraine. All sorts of conflict for Europe. It may result, or almost certainly will result, in more fiscal, which is what Damo's talking about in terms of, so we'd see a lot of goods deflation coming out of all of these tensions around currencies and excess goods, but there'll be more fiscal for NATO and probably domestic stimulus, and that's likely to keep services stronger and potentially inflation. So Europe's in a lot of bother, and we actually saw that last night in stocks. Europe US straight up, Europe straight down. And then there's blackish swan of Ukraine peace settlement. What form that would take, God knows. But
yeah, I think the most likely speculation I've seen is that basically Trump negotiates publicly with both to say this is, they're going to carve off this area. This is going to be an autonomous state in the Ukraine, and if you don't do it, then if Russia doesn't agree, then the US gets involved, and if Ukraine doesn't agree, then the US stops supplying weapons.
Yeah.
So let's forces them both to the
negotiation. It gets done,
Mm.
and Russian commodities flood back into global markets. I mean, not necessarily legally, but if you've got Ukraine peace, then nobody's going to be worried about sanctions anymore.
No, but even if there isn't Ukraine peace, without the US to sort of with a big stick, sort of saying, don't break these, don't break these blockades, or don't, sort of looking at penalties for doing it, then all of a sudden, the desire will go away, or the desire to look the other way is.
What do you think happens if Russia just says, okay, we'll do peace, but then just does war, and the US doesn't supply Ukraine anymore? I mean, I guess Europe steps in. Well, it does step in.
Well, and that's part of the thing we've sort of taken the view is that Europe's going to step in, and also that European defence spending is going to increase regardless.
Yes.
Because there's, with Trump in there, you no longer feel comfortable that if Russia decides to target you next, that the US will definitely help.
Yeah, 100%. So more fiscal, more rate cuts in Europe.
And sorry, that commodities and that Russian commodities, if they do come back into the market, so that's great for, again, that's that whole great for goods inflation, because it means lower transport costs and all that sort of stuff like that. It gives you your bit of a kick in terms of bringing down that that deflationary part from goods, and then with your services still, and so it's generally negative for Australia.
So impacts on emerging markets, not good. Such a strong US dollar and high US yields, it's going to blow up EM currencies and, probably junk debt at the margins. Combine that with, cutting short American demand, and it's quite a difficult scenario for EMs. Much deeper rate cuts. It is the sort of scenario that could produce an EM crisis, but these days most of the EMs, don't have that many external imbalances, and so, if it did happen, it'd probably be idiosyncratic rather than systemic. But EM is not the place to be.
And part of the reason there is China, which is is part of the EM, but China's going to be the biggest competitor to most of these countries now.
A devaluing yuan combined with these is pretty rough on EMs.
Yeah.
And so turning to home, impacts on Australia. Well, I think the Australian dollar is actually going to have a red hot go at 50 cents. I mean a 5 handle over the next year or 18 months. This is all very poor for the Australian dollar. Everything from a strong US dollar to strong US growth, to a much kind of muscled out yield spread to the US. All of that forcing the RBA to come in and cut. China struggling. We know bulks are all oversupplied, and all they really need is a push off the cliff. That comes through, later 2025 in terms of supply. Even if we get, a decent kind of China stimulus in the short term, it won't last very long. And of course, if we get to the worst case scenario where falling Chinese living standards, kind of back Beijing into a corner and it goes for Taiwan, well, Australia's just stuffed at that point. So, yeah.
Time for a sales message. We'll talk about investment implications.
Okay.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so back with the investment implications, starting with the sugar hit. So I just sort of want to talk a little bit about investment philosophy and sort of these ideas that over the longer term, equities tend to give you sort of this 6 to 9% long-term growth in terms of what they provide, whereas bonds sort of more like that sort of 5%, 3 to 5%, and cash, lower again from there. And so, there is certainly this idea that we're going to get this sugar hit. You can come out and say it's not sustainable, and there's all these moral reasons why you might be negative on it. But in a way, the long term is made up from a bunch of different short terms, and if you get a short term sugar hit that gives you earnings up 15, 20%, which half of that's from tax cuts and the other half's from government stimulus and all this stuff's thrown at it. All of a sudden, markets are nowhere near as expensive. And then maybe, on the back end of that, you actually start getting through the AI productivity gains. Maybe there's more, we've already seen some of the weight loss, overall obesity levels in the US economy has started to flatten out. Maybe there's another bit of a kick from some of the health side there. There's lots of different factors that can flow on and surprise you. And so I guess what I'm trying to get to is, yes, it's a sugar hit and it's unsustainable in the long term, but it doesn't mean that it doesn't mean you should just completely sit this one out. I guess is what I'm saying, and say, I'll just wait till the whole thing falls apart. It may fall apart, but then again, if you buy in, if you don't buy in and it doesn't fall apart, you might find yourself, in a few years' time on the outside still looking in.
Yes. Yes. I think it depends how quickly Trump gets tariffs and tax cuts up. You would think if he's got all three houses, it'll be quick. So, we're probably talking 2025 boom. And that's a medium term kind of outlook, which is fair enough to invest into. I think American assets are the only game in town for all of the reasons we've discussed. Europe in all sorts of trouble. China is just fighting an ebbing tide that is accelerating with tariffs, and Trump's going to juice domestic demand and try and repatriate some supply chains. So via his tariffs. So
and he's got the Biden, a lot of that Biden Inflation Reduction Act. That that's not a 4-year plan. That's a lot of the benefits of that are going to come in over the next decade. Yeah. So you've actually already got a bit of a tailwind behind for a lot of that stuff.
So short term, I think bonds are a little bit troubled by the US steepening, like even local bonds, even though a lot of the impacts, nearly all of the impacts outside of Australia, outside of the US are deflationary. Because the American 10-year and 2-year tend to set global interest rates, this is why it's going to be so tough. We're probably going to have a higher interest rate regime with lower growth and inflation everywhere else. And so that kind of doubles down on it being deflationary for everyone other than the US. And so bonds become, through the initial phase of this, it's a difficult environment for bonds, but there will be a certain point at which, there's probably a pivot back into bonds where, this sugar hit, starts to wear off and the tariffs start to weigh.
And that's your question: are we sustainable into another short-term productivity gain, or is
right.
that?
Look, I'm a believer in the sort of US roaring 20s repeat here. Like, I think there's enough productivity, AI and weight loss, and the coming automated cars and all that to give an underpinning of better potential growth in the US. But the tariffs could disrupt that for a period if they really detract from GDP for a while. So, it's possible to see it as a bit of a boom bust scenario, especially if the bond market really, gets a bit stupid and chokes off US housing and other things. But so bonds a little bit painful in the short term, and then there is a pivot somewhere, a year out, maybe sooner, maybe a bit later. If you're looking at the local stock market, all that really matters here is miners and banks. I think miners are an absolute no-go zone, even if we get, some short-term China stimulus. The bulk commodities are oversupplied. The stimulus is not enough. Whatever they do, it won't be enough. And, now we're adding a big blow to Chinese trade. So I'd be steering clear of miners and banks.
Can I just give the only disclaimer to that is not that we think it's likely to happen, but if things get so bad that they decide to look and to say stuff it, let's try and turn the housing market back on again.
Of course.
Of
course.
But we think that's unlikely.
You'd get 18 months or 2 years out of it. Yeah.
Mm.
But that doesn't seem likely. Local banks, probably do okay, but I think the RBA has to accelerate rate cuts as we get into the Trump era, and so then net interest margins come into pressure. They're already at bubble valuations, so I don't see a lot of upside there either. So I guess what I'm really saying is, given the outlook for the Australian dollar, you're probably better off in US assets than Australian. RBA to cut deeper. And so housing up, as usual, with immigration tailwind, unless, of course, it gets really bad and we go in China and we go for the Taiwan scenario. And if you do buy all of that argument, you've got the natural hedge of the Australian dollar, which is, fantastic. Plus, it's an accelerator for American assets if it's going to fall as the US dollar kind of booms in the first phase of the Trump administration. And offsetting all of that and potentially helping prevent a rout in the Australian dollar and a rout in commodities is what we've discussed here, where rather than necessarily all of the weight being carried by central banks around the world fighting, America first, there's more of a role for fiscal. So, that gives more domestic demand, more commodity demand, and mitigates against rate cuts. And that remains to be seen. I think both Europe and China will underdo it and rely on rate cuts, monetary policy. That's what they've always done, and they'll probably do it again. But it bears watching how strong a fiscal response we get, and in particular in Europe. I mean, there really is some existential questions for Europe about how they're going to defend themselves against Russia. So we may well see a big fiscal undertaking in Europe.
Well, and then the other thing though is this idea. It's a medium term thing. Is saying, well, are we going to see a rise of politicians in various countries and Australia, Europe in particular, where the push is saying, I'm just going to get out and spend money. I'm going to, what I'm going to do, it's a populist. I'm going to get out, and there's going to be tax cuts, and there's going to be, more social services, and there's going to be whatever it is, all is the money tree. We're just going to keep shaking that money tree. And the question is there, is this sort of the leading edge of that in terms of saying, it's you've had, some of the sort of analysis you see on the US election at the moment is this whole idea that they've flipped to be the party of the working party now. Yeah, the Republicans are now servicing the working party, and what used to be very much fiscal conservatives, and I think a lot of Trump stuff actually started with the whole Tea Party and these people who are like, you can't keep spending, and now they're the ones out there. Trump's flipped them around, and we're going to spend as much as possible. The question is, do you see that seeping into other arguments, and do you find that let's say in France, for example, that the centre might still be the one in power, but they actually just have to pander to some of they've got all the extremists promising all these grandiose plans that they've actually got to start spending more money anyway. And so, so that's that. I guess the thing is saying, if this is the start of a sort of global movement towards populism and just lots more fiscal spending, then that sort of undoes a lot of those deflationary pressures elsewhere. I suppose. So a key sort of medium-term trend we're looking at.
Yes, absolutely. Definitely worth watching. So we were going to wind up just looking at kind of US sectors, Damo, and where we thought Trump would benefit, and whether these spill over into other economies.
Yeah, so tech is probably where I'd start with this. And tech's sort of an interesting one in that, is there some retribution coming, I suppose? And say, for example, is Elon Musk obviously has Trump's ear? Does he want to try and muzzle some of his competitors and suggest some policies which might benefit Twitter at the or X, at the expense of some of the bigger techs? So that's certainly a real risk in that. The flip side is, these guys are pretty good at the tech companies have been pretty good at exploiting tax loopholes in the past. And I would suggest that Trump isn't overly concerned with tax loopholes. They've probably got a benefit, and they're probably a net beneficiary. And given they've got most of the tech products aren't physical products, it's actually much harder to it's much easier for them to flip their profits around and adjust for loopholes. So they're sort of, I don't know. There's positives and negatives in terms of the.
I'd add a bit of a macro angle on tech. I mean, if you're going to get an inflationary boom in the US, that negatively impacts duration. That's not very good for tech.
No,
in terms of factor.
Yeah, the higher interest rates tends to be more negative
analysis within the stock market. Whether that's enough to actually derail what has been this runaway Mag 7 stuff, it hasn't so far. Well, it has actually over the last kind of 3 months.
Yeah, but they're also
potentially that continues.
Yeah, they're also companies. Well, for the large part, those companies got away with a lot more in terms of the way of price rises than what we saw elsewhere. They don't have. Most of them have relatively monopolistic assets now.
And a big rise in the US dollar is not great for tech either.
No, and it's at its heart, you'd sort of go, tech is, with a more aggressive. The equivalent of the ACCC in the US of trying to crack down on monopolies, and that's what you sort of saw under Biden, is that there is a threat that maybe some of these are at risk of being broken up. Ordinarily, you'd say under a Republican and maybe under Trump 1.0, that's not the case. But again, maybe there's some retribution, so to speak, that's sort of brewing in terms of saying, well, maybe if we break up Facebook to teach them for kicking me off or whatever it is, that's brewing there. So hard to say with tech, I guess, is where I'm trying to get. There's lots of pros and lots of cons. I think it's going to be stock by stock. Yeah, just trying to work out what's going on. Energy, sort of for me, this one's the real danger here is that you might just see energy prices fall dramatically if Russia re-enters. More drilling, less regulations means more volume in the US. And
less war.
Less war. Throw in some throw in more Russian energy, and you could see prices take a bit of a tumble, and that energy sector really suffer. Healthcare is a bit of this is one of these ones where you probably the companies involved there are less likely to be regulated. So US healthcare companies tend to make much wider margins in the US because there's much less regulation. In the US, and they're not sort of dealing with governments that just sort of say no, we're not paying that much for these drugs. It sort of tends to be more open market, and so you'd expect, generally speaking, higher profits for those. The flip side is that it is worth watching those trends in obesity in the US and whether that's genuinely going to, like it looks like that the latest data has. The US obesity rates actually flattening out, and so
it's actually fallen.
Yeah, and so if that's the start of a considerable trend, then that's a relatively big negative for the healthcare sector. They've had this rising tide of every year there's 1% more people that are obese. Where if that turns into going the other direction, then potentially there's sort of a positive for health insurers, so to speak, and a negative for the healthcare providers. Military, Dave?
Well, boom.
So
pretty simple, that one.
Yep.
Well, worldwide boom. I don't think American spending would decelerate. It would probably accelerate under Trump. In fact, it will. That's one of his commitments. And but America First really insists everyone else spends more on military. So military is going to get a lot of money.
Yep. Utilities, reach, infrastructure. These guys are the ones that you'd call more interest rate sensitive. So they're sort of partly the stocks themselves, but a big part of it's what are interest rates doing. And so if we're expecting higher inflation and higher interest rates, then that's a negative for all those guys. And then finally, the US domestic demand and what that flows through into consumer discretionary. So with extra tax cuts, that's probably a good thing for consumer discretionary. The flip side is, you've got all these tariffs, particularly on goods. And so there's sort of a little bit of a choosing which one's the right one to go with. One of the ones I didn't put up on there was the renewable energy sector as well. That's actually one we think that's cheap enough now. I think we've been sort of nibbling at the edges, and we've seen a little bit more weakness in some of these, and we're going to be using this weakness over the next few months to pick up some more in this sector. But I do think there's an element of the biggest problem for most of the renewable sector is actually China, and that China's being explicitly subsidizing its renewable energy companies. And so tariffs might actually be tariffs are likely to be quite positive for the profitability of these companies. It might mean that you don't get as much renewable energy out there, which I think is probably Trump's plan, and he's not sort of against that. But I think the profitability of the providers will be better under these scenarios, and I don't think that Trump is going to change the economics within that sector in any meaningful way. There'll be a little bit that if energy is a bit cheaper, that it's less attractive to change across to the renewables. But the steam train of renewables, the effect of the price spikes we've already seen just mean that there's this inexorable move across, and the prices keep coming down for solar, the prices keep coming down for batteries. We can't see anything Trump doing to meaningfully change any of that technological trend.
Yeah, I guess I'd just reiterate what we did in the Australian section, adding materials and financials as a closeout. Late cycle cyclicals, I guess. Financials probably okay while we're into the early phases of Trump's boom, but fading as it all comes apart and rate cuts resume, and Chinese problem is just, and the US dollar, it really makes it difficult to see a case for materials.
Absolutely. Right. Anything else, Dave, or we've wrap it all up?
No, mate, that's enough.
That's enough. Yeah. Yep. It's so we're back to we won't comment too much on the social aspects of it, but I did want to sort of make one sort of comment that saying, I do think there's from the readings I've got, there's this, what do people learn and all these types of things, and are they learning the right lessons? And I think there's, you can overstate various aspects of the Trump coalition in terms of saying, look, everyone voted for Trump because they want to blow up the entire, they want to blow up the American system because it's not working for them. And that's potentially true for a bunch of people, but it's probably not true for all of them. And other ones just want they just want lower inflation, and they're harking back to those days. And other ones are fooled by the fact that they think Trump's got populist policies that are going to be beneficial for them, whereas they might actually be negative. But I think there's for me, regardless of which one of these you're going to jump on as a key reason for it, that idea that these populist policies and populist leaders are more likely to be elected elsewhere. That's the big thing to come out of this for me, is that regardless of which country you're in, pick Australia, pick Canada, pick UK, Europe, you're going to see the populists trying to play the Trump tune and trying to push down that same type of going, look, it worked for him. Let's see if it works works for me in whichever country. And existing parties are going to have to meet them somewhere in the middle. And there'll be this fear that if you're a fiscal pragmatist and you want to run the whole, you want to run the world the way it was run in the 2020s or the 2010s, that you're not going to be able to. And the fear of actually losing to a populist will mean that you got to change the policies through to something that's more in tune with what we're seeing in the US. So yes, I think that's regardless of whether it works or not elsewhere, I do think that's what we're looking at for the next few years at least.
Yes. I'll just add one thing to that, and I don't talk about this much, but since you raised social issues, I see the Trump red sweep as a kind of woke counter-reformation. I think the left lost touch with class politics, became obsessed with marginal politics that was very alienating to its traditional base. And, the weirdest thing about the Trump platform is it's this bizarre amalgam of, sort of liberal things like deregulation and tax cuts combined with very traditionally left tariffs.
Yep.
which protectionism was always the baby of the left, protecting factory workers, etc. And I think the culture wars that have erupted around woke have played an unbelievable role in hoodwinking working people into voting for a party that actually doesn't have their best interests at heart. So, that may play into what you're describing, where they need to be bought off or at least propped up, or, they need more tax cuts or whatever it is,
Yep. Well, and it's the or they need at least the appearance that they're being
Yes.
given.
Well,
Probably the more important.
Yes, they do. I mean, the classic case here is the blue wall in the US, which suffered the most under Trump's first round of tariffs, and then will now suffer the most under his second round of tariffs, and yet they're back for more.
Yeah. Yep. But that's
because they kind of sympathise with his values. So
yes, but I guess that's where where I'm leading with this is, I think there's all these moral lessons and everything that's coming out of it. But I think that, to me, the net effect is, whether you think that there's, people will always get what's due to them, and the good will always win out, or whatever it is, that you've got these ideas that you can't keep spending this money if you don't have it, and there's all these factors you might have as core beliefs. But regardless of what those core beliefs are, for the next 4 or 5 years, we're moving in the opposite direction.
Yeah.
And so so that's the hand we've been dealt. You got to work out how to play it from an investment perspective.
Well, in closing, then, I mean, you probably have to say, if that really got out of hand,
the
then
70s style inflation.
Yeah. And gold's taking a bit of a thrashing at the moment with the runaway US dollar and high and rising US real interest rates, and that makes perfect sense. It's actually been defying those trends irrationally for a while. But, maybe that resistance makes sense if you think that this populism and fiscal impulse gets really, really out of control.
Yeah. But, well, I guess for me, I just think we're a long way away from it. And I guess we've spoken about these deflationary forces. And for me, I'm thinking, well, if we've got all these deflationary forces being pushed out of China and lower energy prices and all that sort of flowing on things, meeting some inflationary forces from all this extra spending, and the net effect is inflation might be low. It might be, it might not be.
Yeah.
It certainly won't be as high as what you might expect under these types of fiscal spending.
Yeah.
That's then encouraging to say, well, if I can spend that much of my budget and we didn't see inflation, maybe I can do more, and maybe I can do more until eventually you can't. But that's the that's the other thing is this.
I think we've made our base case pretty plain, but it is an interesting risk case that you can't ignore. The fiscal impulse behind populism could be a big deal.
Yes, and that's your sort of 5-year view, but don't ignore the fact that, as I said, there's a sugar hit coming, and that sugar hit might have another sugar hit after it, which might have another productivity boom after it, which might, so you can sort of take noble views right now about what's right and people will eventually get what's coming for them, but you might be sitting out the market and miss on all this upside.
Yeah, exactly.
Okay, I think that's probably enough for there. We're on every Thursday at 12:30, so love to hear your questions. I've had a few comments today, but nothing sort of I'd classify as a question. But yes, and certainly write in with any topics. You can get all our podcasts on YouTube, plus all the usual locations, Spotify, Apple, etc. Both major and minor ones. Come to our blog. You can read about you can sign yourself up for a newsletter and read about all of our thoughts on there. Thanks, Dave, and we will catch you next time.
Pleasure. Farewell, everybody.